Thank you very much, and a warm welcome everyone to this SKAGEN M2 seminar. We're going to spend, as always, like 30 to 40 minutes talking about global real estate, and I will bring you the perspective why I think it's a good opportunity right now, or a good timing for this seminar. Also, anecdotally, by several meetings and well-attended seminar this further before today. So I think we can all identify something out there that is making this segment extra interesting at the moment. So let's start with the market, as I assume you all know what SKAGEN M2 is about. This is about investing in listed global real estate within all the sub-segments. So where are we now in terms of market? At the left, we have MSCI ACWI, all country, all subsectors, performing about 14% in euro year to date, which is about 10% points above real estate benchmark, the Morgan Stanley World Real Estate. We have seen this picture for many years now, that real estate has performed less good than the big broad market, and I will try to give my view why I think this is about to change soon. Something has happened now in July, and it has been the start of a good performance among the US real estate names. We saw that in July, specifically when we had these inflation numbers coming through, and markets started to believe again in a Fed rate cut sooner than later. We all remember what happened Q4 in 2023, when markets started to discount 5 to 6 Fed cuts, and they over discounted this in the real estate market and in the market as a whole as well. Then this was a little bit overshooting. We saw inflation coming through again, and it was pretty dark out there this spring in terms of inflation and expectations about the future. This suddenly changed in July. Looking at the other staples here, we have the dark green bar is European real estate. We have the blue one is SKAGEN M2. The light green is the Scandinavian real estate market, and the orange is the Asia Pacific market. So this is the big picture. So in terms of relative performance here, we can look at this picture that I find fairly interesting, to be honest. I will try to explain. The gray shadow area here is real estate stocks versus or in relation to the big sector. In this case, it's MSCI ACWI and MSCI real estate. The brown bar or the line is US 10-year bond yield with inversed scale on the right side, meaning when this is going down, it means that the bond yield is coming up. This has been the picture since we came out of the record year of 2021. And the reason for that is obviously inflation coming through, and interest rates started to be discounted, the hikes of interest rates, and we saw that come through as well. With a small exception in this period, and it was in Q4 that I mentioned earlier, with the Fed anticipated rate cuts. After that, this spring, market came back again, and real estate underperformed, as we have seen over the last years. Something happened, which I had tried to point out with a small circle there, bottom right. It is this turn in US expectations. I claim that it almost has been, or many investors have actually said it's different this time. We will not see US economy going down due to the interest rate this time. Of course, that was wrong, and investors start to price in that now. So they have started to talk about the slower economy in the US. I will show later on why that is different from, for instance, Sweden and Europe. But this is the picture, and I think this might be right this time. I hope it will be right this time, that we will not see inflation coming through again at the level we saw earlier. But who knows? We have potential oil price, we have potential wage increases that are higher than expectations and so forth. But this is the one picture I find most interesting in relative terms. You can also look at this in real interest rate terms. This is also, again, a 10-year real yields in reversed order this time as well. And the brown line here is real estate relative to equities. This is in the US. So we have taken it down a bit. But the US is the biggest market in the world in terms of real estate, both listed and unlisted. So this is a fairly interesting picture to show. Between 2000 and 2013, we saw the relative performance, i.e. the brown line is above 1.0. The relative performance versus other equities or broad benchmark was better performance. And this has to do, of course, with the 10-year real yields came down to almost from 4% to -1 during this time. Then we know what happened, especially at the end of the time, what we saw on the other slide. Real yields came up and started to affect real estate stocks on the listed scene. So there are actually reasons to believe that we will see the reversal of this, if one believes that we will see interest rate cuts ahead of this. In terms of relative valuation, this is again on global perspective, the global real estate scene. We have the substance or price book, and we have the cash flow metric price cash flow. In both cases, we have relatively low valuation in terms of the total benchmark, i.e. other real estate or other stocks or assets. One might claim that the stock market as a whole is overpriced or overvalued. But still, real estate is much less pricey in that case than the other sectors, which is important because investors seek typically, or anyway, those that want to buy cheap and sell expensive, they try to find the big fishes now in the value waters, and this is important for many investors to seek after. And I think this has also to do with the revaluation we have seen in the US since July. In terms of absolute valuation, I've shown you this before. On top, we have the substance, the net asset value, and this is again a proxy of the global market. This masks a lot of differences. To mention a few, US is now trading at a premium again, 10% premium on the real estate market. Hong Kong is 60% discount, Europe is 25% discount, etc., etc. So you have big differences in sectors, subsegments, and geographies. But still, it's priced a little bit above the historical valuation going back to beginning of the 90s. But still, one has to remember here, a lot of value reversal has been seen in the listed names, or the market has actually discounted a lot of the valuation drop that we have seen over the last years. So if one believes that the interest rate will come down and the economies are fairly stable or growing, or even in some cases good growth, substance will revalue upwards, and we will have a higher discount, all else equal. But typically on the listed market, we will see the valuations is growing into the higher values as well. So this is nothing that I find alarming. This in absolute terms, evaluations, rather the opposite in many cases. If you look at the proxy on the cap rate or the implied yield here in terms of EV/EBITDA, again, it's on a global basis. A lot of big differences. We have yields way above 10%, for instance, in China, Hong Kong, and we have subsegments that are trading below 5.5, as we see here as an aggregate. So again, geography and subsegments are different. But again, if one has to believe the belief that the interest rate will come down, this will likely follow suit as well. You have some lags in this before interest rates is coming into the profit and loss. We have revaluations, etc. So you always have a time lag here. This is actually supportive rather than the opposite on why real estate will why I think real estate will have a nice ride from here down the road. The third thing I would like to lift is more about the US market maybe than the European or the Scandinavian, even though it works in the same way. This is actually the earnings growth, S&P 500 versus the listed US real estate names. What we can see here is, of course, that the listed real estate names have a more defensive growth profile than the S&P as a whole. Why is this? Well, we have talked about this before. The characteristics of real estate, we have these long contracts, they are inflation protected, etc. It's typically more less volatile and more foreseeable than many other sectors that are have earnings growth up and down. In this case, when interest rate starts to bite on a positive way, earnings typically go up for real estate as a capital intensive and typically heavy balance sheet sector. Why is this important? Well, I think this is one of the explanations why real estate has performed well in the US lately, not only interest rate, because as I said initially, many investors started to discount all the extremely strong economy that we have seen in the US and more or less claimed out of some statements I've read that it's different this time. We will not see the interest rate hurts the economy in short term anyway. And this is probably not true this time either. So what investors will do, they will seek after more foreseeability and more stability. And then you look after real estate because of the dividends are fairly attractive versus the bond yield, for instance, which is a proxy in the US. But also, typically, if you have this late cycle or a declining economy, the interest rates tend to come down, which is beneficiary for real assets as real estate. So this is also a very strong argument for the real estate. But the strongest argument is here actually. If we look after the GDP growth in the US, we see here that it's expected to come down from 2.3 to 1.7, and this is what I mean. This is not recession. It's about slower economy. Then you search after this less volatile earnings growth, and real assets are supported by interest rate cuts. And also history has shown that in these late cycles, listed real estate in the US has been the most beneficiary segment to be in just out of that reason. In Sweden, by the way, and why do I show Sweden? Well, we have a record high exposure to Sweden at the moment. It's 11% of the portfolio. So this is interesting. Europe is also overweight in the portfolio. So here we see the opposite. We see the GDP growth is coming through. If this 200 economists have right, or I'm not sure, could be right, could be wrong. It's 200 economists anyways, consensus economists that has made this forecast. Sweden is the winner on this if they are right. So we will go from very low GDP growth, barely nothing, to 2.8 next year. And the year after that, we have an election year, and typically then they will spread gold on the streets. So that might also be a good year. Earnings forecast looks fairly well on the right. S&P 500, the Swedish market, and here also the European Euro stocks, which is, of course, in my segment, it has to do with lower interest rate, cutting the costs for this capital intensive segment, which is partly that's the reason why we see this earnings growth, but also a fairly strong economy, meaning for my segment, less vacancy and higher demand, which is also good. So we have to have a split thought here, one about US and one about Scandinavia and Europe, which is the highest weight in the fund. This is the most important picture, right or wrong again. It's the Fed fund futures and the central bank's policy rate development. As we stand here today, this is actually the path that the economists have foreseen, and this is really fantastic for the real asset or all asset class basically. And why is this? Yes, not only because of people getting a higher salary from lower interest rate and lower amortization. This means, of course, lower required rate of return, which is very, very good for the asset valuation. Of course, this is one part of it. We have the top line part as well, meaning, as I said, demand, low vacancy rates, etc., etc. But if we see the forecasted economic growth in Europe, it's not the best, but still it's pointing upwards. And Sweden, the champion here at the moment, it looks fairly well. On the other, or one can consider it as a downside protection anyway, everything else equal. So this looks really good for real estate. And I think this is the most strongest argument, of course, for real estate. But will this take a year? Will it take 2 years, 3 years? I'm not sure. I don't know. The only thing is that I see the gravity turning downwards as we speak. Things might happen, but as we speak, it looks really interesting. If we look at the history in terms of US and Fed tightening cycle, meaning hiked interest rates, this go back to late 80s. We can see what is happening after this cycle and what is probably going to happen now in September. We don't know the pace of it or the amount of or if it's 25 bips or 50 bips or whatever it might be, but we have a highly probability that they will lower the interest rate, and that will be really meaningful for the real estate sector. With that said, some of the price cut is already in the price. Yesterday we saw a cut in Sweden. It was the second. First one was in May. Real estate market didn't react that much because this was in the price. But the difference between now and back in Q4, for instance, is the pace of discounting the interest rates. We were a little bit too optimistic in Q4. In Sweden, we had a really strong performing quarter, and then it has been fairly stable since then. We took out a lot of the interest rate cut in 3 months there. What I think the market is missing here is the potential expansion. Why do we have expansion? Well, if you have availability to credit, you have now still fairly cheap assets to buy, especially on the listed market, but also on the unlisted market. We have seen that transaction have started. So mindset from these real estate companies has gone from surviving, refinancing to growth now. That is not in the price because we are not there mentally yet. But the day when we realize we are in an interest rate cut cycle, that will be amplified. And I'm pretty sure that part is not discounted yet because it holds a lot of uncertainty. We have seen this before. It can be shown from many markets. I choose US, longest history, biggest market. This is after the tightening cycle, which what is the most or the most positive in terms of performance versus direct or indirect real estate, unlisted real estate is the light bar. S&P 500 is the gray bar, or listed US real estate is the dark blue bar. So this is the time after the tightening cycle. We have same picture from Sweden, basically, not the same numbers, of course, or other market, but this is from the beginning of 1990s. And I think this is, if history is any holds any guidance, this is what to be expected going forward, or we are actually in that period as we speak. The last argument I have, and this is also a random picture, it could be attributed everywhere basically, and it's basically the principle here that it's important. We have the supply and demand equation that we always talk about in terms of real estate. Oversupply, undersupply drives demand, or the vice versa. This is a good picture from what happened actually from the beginning of 2020. We had the COVID, everybody was putting in a break. It was reversed within 1 year basically, and we had this record year for real estate when things got a little bit more clear. Coming into cost inflation, coming into hiked interest rates, nobody built anything more. You couldn't go to the bank because they had closed the doors, and bond market was basically off as well. So it means that a lot of things has not been built for some years because speculation was off the table, and also we can see it here with here in Sweden or in Norway for that sake with housing. We have construction companies are struggling still, etc. We see this. I took this picture because I find it fairly interesting from the US. It's pretty fresh. This is a percentage under construction out of the total inventory. And here we see multifamily, office, retail, and industrial logistic. Multifamily is very interesting. We talked about, or the market talked about oversupply for many years up till this year, basically. And we can also see that the thing that was started to be constructed in 21, 22 have come out on the market, is start to be absorbed, but not very few new project is started, which means that those that have standing assets generating cash flow or are put on the market now will be absorbed. And then we also have this mismatch in timing because it takes some time to build a logistic hub or whatever you might have. So this dynamic will also make real estate perform better, the ones that have standing assets, which most of the listed real estate names have. So this dynamic is important. Sometimes I exemplify Stockholm market. The office market here is fairly well working still. Many factors, of course, but one factor and one important factor is that a few cranes has been seen over the last 5 years. There has been very few construction projects, for instance, for office. And those that has been new built has set the standard or been in the standard for the demand, meaning sustainable, certified, attract young people, and new way of working, etc. So this is an important slide. So to summarize the market, valuation is not the cheapest we have seen. Some of the interest rates has been priced in, not everything, and especially it's relatively cheap, but also I think a lot of the potential growth ahead underpinned by strong growth in some markets, or some growth anyway, and lower interest rates, and hence costs will also work in favor for the values going down the road. Inflation, we can't speak about that much because I don't know where it goes, but the experts tend to think it will come down and the policy rates will follow, and all the arrows are pointing in that direction. So that will be the main thing for real estate going through. And market has been a little bit more reluctant to price that in now than they were in Q4 2023. US is a very strong example with awakening in July. And we have seen also the listed real estate space has been one of the best after the tightening cycles. Almost can be seen in almost all the markets if you take it over the longer term period, and you have a lot of tightening cycles monitored. One thing that I haven't mentioned that much, but is very, very important, is the transaction capital markets are opening again. We have had bond markets that has been basically closed, banks has closed the doors, and it has been a fairly hard market to raise capital, especially from the bank sector or the bond market. But this is something that is changing as we speak every day, and we have also seen some are trying to calling the throat of the market. We have seen very good example is Blackstone in April. They bought American company for $10 billion, listed multifamily home. They also bought the Canadian equivalent a month before. So they tried to call the right timing in the market. Right or wrong, it remains to be seen, but still, as of now, they have been more right than wrong, to put it that way. And we see also increased M&A on a daily basis now. We had, for instance, in a portfolio, Arima, the Spanish office operator, taken out here in April and May. This is something that will increase over time, I think, because it's the game theory. It will be cheaper tomorrow to lend money for M&A, but on the other hand, some competitors may take the target you have spotted on the market. So that's why I think we will not wait too long for that M&A mania to roll again. We have still a valuation gap between listed and unlisted, and this is interesting in terms of M&A, of course, but also in the world I live with listed real estate. We take our haircut initially. We are also always in forefront of ups and downs in terms of the real estate market. So valuations has been taken in another way than on the unlisted or direct market, where you more smooth it out. That's why it's less volatile. So there are some discrepancies between the listed and unlisted, and investors that can invest in both can actually play those both. So now it's in favor in valuation for the direct or higher value than the listed market. So that has shrinking a bit, but it's still differences. We have shifted from refinance to growth, also important because you see things live with new eyes, and you start to get some positive vibes again, which is very, very important. And also the construction cut that we had some years ago, starting to get invisible now with stable or an increased demand, but you have a supply situation that are much less than a couple of years ago. And I exemplify that with a multi-housing segment in the US. It was just some years ago we talked about this huge housing deficit in the US. Then one started to talk about in some places the oversupply situation, and now a lot of that is absorbed, but a lot less is constructed, and that is a very good combination. And real estate market is very polarized. We talk, for example, office on one hand and data center on the other hand. Data center has the growth and are doubtless the most interesting commercial segment next 5 to 10 years probably, because they have this sweet spot with low demand, high supply, and they can be able to increase the rents fairly well. And we don't see that in the office side at the moment. With that said, there are interesting offices out there, but they have to tick some boxes to be interesting in my eyes. Over to the fund. We talked about the market, and I hope you got the benefits of real estate going forward, hopefully. This is the performance. Since inception, we have performed 5% net of all fees since the inception. With that said, we have passed one of the worst interest rate hike periods in decades in terms of pace and amount. So I hope and really think that this number 5 will increase over time if they start to take down the fairly high interest rates, and we have some good pace in the economy as well. Because if not capital costs or growth in the economy is affecting real estate, I'm not sure what will, to be honest. So I'm fairly positive going forward, and one should not forget the pandemic either. In our markets here, it was fairly okay since we didn't stop or close down everything, but they did actually in Asia and US, etc. So one should remember the last 4 years has been a roller coaster ride for this segment and all the real assets actually out there. You pay us to find the right stocks. We have done that over time. It's the light blue bars, or actually this shows that we find more good stocks than bad stocks. It's the selection effect or the stock selection. The gray-green bar here is the allocation. So we have been allocated in the wrong place and we have had the wrong currencies. That is what this picture says, but the stock selection is good. The negatives here or below the line can be explained by us hoping for Europe, the opening of COVID, then a war breakout. The dollar went very, very strong, and the US market also continued to be strong as they were a bit away from the European war. So we have catched up a little bit, and now it seems that the US dollar is coming down again due to the potential interest rate cut here. Let's see what's happened. With that said, we're not speculating in currencies, but we try to balance it. This is what has worked and not since beginning of the year. We have again mentioned multifamily housing in the US on the left side, Independence Realty Trust. It was a big signal for the market when Blackstone came in and took out two similar companies in a unregulated market, which also benefited the holding that we had working exactly the same segment. On the negative side, we have Digital Bridge. It's a growth company mainly. It's a digital real estate or digital infrastructure. It's growth in the terms that they have a fairly high growth, these subsegments. This is actually an asset manager equivalent with Blackstone, but they are focusing on digital real estate instead. Beginning of the year when nobody believes that the US would cut interest rate, this type of company struggled a little bit, but they also had to guide down the amount of assets they would rise due to the high interest rates. So I'm full of confidence that this company will be on the left side, not far away in the future. And another new company is Nexity, the French housing builder. Started out well from very, very low levels. This is an interest rate derivative. But unfortunately, we saw this presidential election turmoil in France, and that spoiled the party. This is a small position, but has hurt the fund anyway. So let's leave that and go over to this picture that many of you have actually seen for many years now. Just show the portfolio and the stability on the the right side. That's the steady earners, a little bit what we call and refer to defensive growth. Student housing, for instance, is not that economical affected if the economy goes down or the cycle turns. People start to tend to start studying, etc., when that economy comes down, or the long contracts that we have in towers, for instance, etc., etc. On the left side is a little bit more economical affected, office, hotels, house builders, etc. So this is just a risk perspective or earnings perspective, if one like to call it that way. We have entered 4 new positions this year. Helios Towers is a UK-listed name, towers in Africa and also one in Oman in Middle East. I mentioned Nexity, and we also participated in the IPO of Public Property Invest on very, very low levels, almost 60% plus discount on net asset value. This is public properties with very, very strong and solid tenants with long contracts. Prisma is the first Swedish IPO in a long time, which is also discount retail properties, high yield, strong cash flows, which also will benefit if this GDP growth is coming true that is forecasted. On the sell side, we have MRV, it's a house builder in Brazil. It started to get a little bit too political in this segment, so we sold out. Also negative on the FX. Arima was taken out on good discount, so we sold out. Good premium. We sold out. Diös, Swedish diversified company, we bought when the days were as dark they could get in October 2023 and sold with almost 100% profit in January this year, and switched it to other Swedish and Norwegian on the left side. Again, portfolio about where it usually are, about 47-48% concentration, which we find good. Portfolio holds about 31 holdings at the moment, which is good for us to obtain the diversification, but also to be able to monitor the portfolio properly. Here you can see mainly digital infrastructure, but we also have old school properties like self-storage, residential rental, logistics, etc. So we are skewed towards the yield curve shift downwards. There's also clear logistic warehouse 1/4, digital infrastructure 1/5, residential rental 1/5, very little office, and a little bit of everything. And this is what you get with this global portfolio. You get subsegments you don't find in Scandinavia, not that much anyway in Europe either. You have towers, you have some data center in some companies as a buy part, but still you can find a lot of interesting holdings with a global perspective. Underweight in the US still, but we took it up in the beginning of the year to it's almost 40% now, and it had to do with potential interest rate cuts and the repricing of that, and it still is, but mainly it's interesting companies that we found there. As you also could see out of the attribution, which companies that had performed best was mainly US names. Otherwise, we have a good diversification, and we are a global portfolio. I mentioned earlier we have a high weight in Sweden. We have sold out, as I mentioned, and bought new ones. And Sweden is still interesting, but it holds high risk as always. It was just a couple of years ago, Scandinavia benchmark lost 45% in local terms. So one should be aware of that. It has to do rather with the company names rather than the segment or country. That's important to emphasize here. So this is also a picture that we always shows, has done for many years. So it has nothing to do with high interest rates, but we still sleep good at night, and we will sleep good at night going forward as well, since we have a lot of focus on this. Interest rate ratio coverage over 4 times. Average loan maturity is 5 years, so we have some really long and some a little bit less long. Not that important down the road maybe, since hopefully the interest rates will come down, but still it's important today because it will not go down immensely overnight. So the company still has to be paying their interest rates. LTV, loan to value, is 37%, and with that said, a lot of value has been coming down, which typically means this number will go up, but 37 is a low number. 80% fixed or hedged debt or loans is also very strong, and net gearing, i.e. equity in total debts, is almost 90%, which also is a strong number. We are cheaper than the benchmark, both on the substance, but more importantly on the cash flow, EV/EBITDA. We have a stronger earnings yield than the benchmark, and the only thing we have not, and I typically always explains this because it's perfectly all right according to our philosophy, is that we have a lower dividend yield, and we don't hand out dividend yield to our investors. It's reinvested in the fund, and that's how we like our companies to do as well. If they have good products, we want to have good return on investments instead of handing them out to the investors. So it's perfectly clear, and we have never been higher in dividends, since we are not only invested in REITs, for instance, that has to pay out 90%. So to sum this up, before I take questions, if you buy into SKAGEN M2, you know this, you get a strong balance sheet portfolio with cash flow generation, high focus on that. You have a lot of fixed and hedged debt, cheaper than benchmark, and we are into segments with long structural demand, like data center infrastructure, housing as well, for that sake. Depends on where you're looking. But you have to have the structural tailwind from the demand side. Yes, I think I have mentioned the rest, and thank you for taking your time. I really appreciate if you have any questions. Thank you.